And longtime guest David Burrows is pretty constructive on the markets. He's the president and chief investment strategist at Barometer Capital Management. David, it's nice to see you.
Great to be here.
I guess I'll just, because it is a Fed day, how much of the interest rate story are you watching versus the sort of the broader shape and health of the markets?
Right. So, we've seen the expectations for a Fed rate cut come down substantially. I think it's like a 1% expectation for today. That's a good thing. I mean, if the economy was weakening sharply and we were really needing to get cutting, that's one thing, but we're not. We're seeing the economy in general stay pretty resilient. Inflation's coming down in bits and pieces. But the fact that we're pushing out rate cuts means that things are still very, very resilient. And when we look at earnings estimates, they're continuing to be pretty good as we go out through the course of the year.
And I think, I was looking, you always give us some notes before you come on. It would suggest that you have some pretty constructive views on a range of sectors. It's not a story you have to pick this or that. There's
Right.
a lot of things that you like that you're seeing in a lot of different areas.
Yeah, so of course, since January of 23, tech has been on a tear. And it was a very, very important sector and still is. Having said that, since October, its relative performance versus the rest of the market has been flat to down. So there's some obvious names like Nvidia, which is one of our big 5 holdings. But we've actually taken our tech weight down to about a half of what the S&P is. Because, for instance, financials and industrials, which we've talked about in this show a few times, they're up 30% from the end of October. And they can certainly correct. But if you look at the top relative strength stocks in the market, like out of the top 12, about 8 of them are industrial companies. So there's lots of representation from different parts of the market that, in general, are helped by this stronger economy.
Yeah, I mean, it was really, it felt like financials and industrials that did some of the early heavy lifting for the TSX coming into this year. Dividends is always a key area that you're watching. In financials, just to take an American name as an example, you've recommended JP Morgan many times. They had some dividend news today.
Yeah.
Is it an either or with dividends? Is dividends just sort of getting protection at a time of uncertainty, or actually is it additive to the story?
We cut them into 2 cohorts, right? There are high dividend payers, generally slowly growing companies without a lot of need for capital, and they pay out a relatively high dividend. The problem is that's directly comparable to whatever the bond yield is, right, for which is maybe better. If you think that rates might be a little stickier or inflation might stay a little stronger in general, we would prefer to have dividend growers. So we're happy to get a lower dividend, but companies that have had a record of continually paying more. So JP Morgan, for instance, just raised its dividend for the 2nd time this year. It's a 15% dividend increase over the course of the year. If you can get a decent dividend that's growing at 15%, I'd way rather have that.
And just to clarify, because if yields are what they are in the bond market because people have expectations on maybe interest rates staying a little higher for longer, that just creates competition for money flow, and companies that have, let's say, a higher dividend yield but aren't growing their dividends quickly, they're going to compete for investor attention.
Exactly. I mean, if you think that inflation could stay a little higher, your cost of living is going up, and you want an income stream that's growing along with it, or maybe at a faster pace. The history is that dividend-growing companies, on average, have had significantly less volatility than the index, but actually have had excess return above the index. So it's almost one of the only free lunches in investing.
Yeah, and we did a segment just on some of the companies that Bloomberg projects will raise their dividends, and there are technology companies. Meta made that list. I do want to, on technology, come back to Nvidia because there's a massive obsession with this stock right now. And I think there's different schools of thought. There is, uh-oh, I missed that one, can I get in? There's, wow, I really lucked out with that one, should I lock in some profits?
Right.
It sounded like you said it's a pretty core holding.
It is. It's one of our big 5 holdings. In fact, we had to cut it back about a month ago. We originally bought it at about $190, so it became a larger position than we're fully comfortable with. But what they're creating is a platform, right? Everybody's concerned that somebody's going to come in and eat their lunch by creating a better chip. The fact is, they're so far ahead. AMD was maybe catching up to the H100 chip, and with this new chip architecture that they've come forward, ultimately like 20 times more 25 times more powerful for inference, which means that nobody's close. And so everybody's building on this architecture for AI training and inference. And we think that it's going to be very, very hard for someone to take their lead.
It has felt like just in the world of metrics, like something like the PEG ratio, which is a stock's price compared to the earnings growth. If you're trying to find a good justification for a name like Nvidia, that would be an example, because the earnings expectations are continuing to climb, even though the stock has gone up so much.
I mean, we don't know what the growth rate might be because they can only produce so much. I mean, there are views that they may have already sold out through the end of 2025, their new architecture. So what might the total demand be? We don't know. And listen, there's risk in a momentum-oriented stock, but this one has a lot of fundamental strength behind it.
Just before I let you go, we've talked about some of the things you like about the market and some of the things you like in the market. Where would be the areas you'd be cautious of for investors right now?
Well, one of the interesting things is that people concerned about a slowdown in the economy, a lot of managers and investors overweighted defensive, high dividend paying stocks in utilities and consumer staples and real estate investment trusts, and they've underperformed. And on the other side, you've got, on the positive side, you've got energy and banks and insurance and some global markets that are really underowned, and they're performing really well. So we think there's a risk that high dividend paying stocks could continue to see sellers, and that money slowly could work its way into these other groups. And we want to be there. We want to own what other people are going to want to own.
Okay.